Yes, good afternoon, everyone. First of all, I think we are late. So basically, I'm sorry to all of you for the purpose of being late in this webinar. But let us take it, let us take it this ahead. So today's topic is mainly on common non-compliances in financial statements of companies as per accounting standards. Dear friends, one of the most important thing is the quality of financial reporting. Why quality is relevant? Because the stakeholders, investors, or anybody they are going to look at financial statements for the purpose of taking decisions. So it is not only for the purpose of the management the financials are prepared, however, they are also prepared for many stakeholders, which includes investors, venture capitalists, bankers, financiers, and so on. So when we just look at the financial statements, the first and foremost very important thing is that the responsibility of preparation of financial statements is of management. Practically, there may be so many cases where it has been seen that the responsibility may be seen as casted upon the auditors. However, frankly speaking, when you just look at the main auditor's report, it says the primary responsibility for preparation of financial statements is of management, and the auditor's responsibility is to express an opinion on true and fairness of financial statements. Dear friends, now that means the quality of financial reporting is important, but what do you mean by quality? That is a question. Everybody feels that the financial reporting, the preparation which they have done is of the utmost quality, but quality can be measured by way of the standards. So we need to refer to standards on auditing if you're talking about the quality of auditing, and if we want to refer to the quality of financial reporting, we need to look at the first and foremost two aspects. First is with respect to accounting standards. The accounting standards have been prescribed by Companies Act 2013, which have been issued in accordance with the ICI and NAFRA. The accounting standards provide the principles for preparation of financial statements. Second very important thing, we also need to look at the compliance with respect to laws and regulations which are applicable to particular enterprises. If you are doing audit of the Companies Act, if it's LLP, if it's a partnership firm, it may be with respect to the law, it may be Income Tax Act, for which we need to look at the compliance. So with this brief word, I think one of the most important things in today's presentations, we are going to talk about how can we increase the quality of reporting. And the quality of reporting, for that, we are going to refer to the few common non-compliance with respect to accounting standards and Companies Act. Before we talk about the few common non-compliances, let us look at one of the very, very important saying by Warren Buffett. He said that it's good to learn from your mistakes. However, it is better to learn from other people's mistakes. So that means what? We should have learning from what others have done, not by doing ourselves and then changing it. And the common mistakes which we are going to refer today, that particular point will help us to ensure that we should not commit the same mistake. If somebody has done mistakes, doesn't mean that we do and then learn. Let us learn which mistakes are generally being done. And this is from the ICAI material. The ICAI has already various bodies, which includes one FRRB, Financial Reporting Review Board, and second is QRB. The Financial Reporting Review Board extract and verify financial statements of certain companies, and then from that they compile the non-compliances. So these particular non-compliances are already compiled and provided by ICI by way of of publication, and from that I have extracted few very relevant, very important non-compliances for all of us to understand and learn. So today's webinar, we are going to talk about non-compliances related to accounting standards, that is of disclosure of accounting policy, inventories, revenue recognition, employee benefits, related party transactions, intangible assets, provisions, contingent liability, and contingent assets. So these are the few for accounting standards. Second is observations on Companies Act. And then we're going to talk about on laws and regulations. Now, next point is on non-compliances related to accounting standards. First is on disclosure of accounting policy. Dear friends, I think I have seen in various financial statements that the accounting policies have been mentioned, but none has taken understanding with respect to what is written there. Only one thing how the investors or stakeholders can understand is from the way the accounting policies have been disclosed. So this is a particular part of the financial statement, which is the most important, where the company is providing information how the accounting is being done. The financial statements are prepared based on accounting policy, and which are the very, very critical accounting policy which has been considered by the company for the purpose of preparation of financial statements. So there are few financial statements where there is no mention of borrowing cost accounting policy, valuation of inventories, accounting for investments, employee benefits, accounting for taxes on income, impairment of assets, provisions, contingent liability, contingent assets. A question which may come into picture, that if I don't have any impairment, then do I require to prepare and provide accounting policy of impairment of assets? Yes, you are required. Why? If you are not the impairment because of the accounting policy which you have selected. So in impairment of assets, you mentioned that the company does compare the assets carrying amount with the recoverable amount, and wherever the carrying amount is higher than recoverable amount, then impairment is done. So if the company doesn't have any impairment loss, why there is no impairment loss? Because it means that the carrying amount is not higher than recoverable amount, or recoverable amount is higher than carrying amount. That is the reason why the company has not done any impairment. So impairment of asset policy is required even though you don't have an impairment. Same thing, employee benefits. Now, every company would have a certain case of the employees. It may be a contractor, it may be a part-time, it may be full-time. So wherever the salary is being paid, even though you don't have any other obligations, you may have to provide the disclosure of employee benefits. Investment. When you look at the financial statements of a company, there was investment in balance sheet. So where in the balance sheet there is investment, how investment is accounted? Is it a cost, fair value, or other measures? So in that case, accounting for investment is required. Then inventory. So if there is inventory is there, then how inventory is measured? Valuation of inventory, how it is done? So accounting policy is required. AS1 says that basically the accounting policy is nothing but the accounting principles which a company has taken for the purpose of preparation and presentation of financial statements. So the accounting policy provides information to the stakeholders, to the external persons, to understand how the accounts are prepared. That means the few accounting policy which are critical, which are significant, need to be done. So what is to be done? I think first and foremost yardstick is that please look at the profit and loss account. Please look at your balance sheet. In the profit and loss account, if you are having revenue from operations, sale of goods, then there has to be an accounting policy which says that how the sale of goods is being recognized. If you have services, then your accounting policy should have the information of the income from services. If you're having interest income, then accounting policy should talk about the interest income, how it is accounted. If you're having investment, if you're having property, plant, equipment, if you're having intangible assets, so your accounting policy should talk about accounting of intangible assets. And there are few accounting policy which will generally be there irrespective of the transaction, which I already given example of impairment of assets. Let us look at the next point, that is AS2, the inventories. Incorrect disclosure of valuation of inventories. If we just look at AS2, AS2 says that how to value inventory. Let us look at a few annual report, how they are disclosing accounting policy for inventory valuation. In one of the cases, it was mentioned that the stock of cards are valued at cost and on FIFO basis, and it includes all applicable overheads in bringing the inventories to their present location and conditions. Work in progress is valued at cost. Second, companies mentioned work in progress is valued at direct raw cost and appropriate cost of completed process. Raw materials valued at average cost. See, when I'm just giving you the particular extract of annual report, I think you will be able to understand that what is the quality of the reporting and what is incorrect. The incorrect is the valuation of inventory, and for that it says that paragraph 3.2, 5 and 6 of AS2, it provides that the inventory shall be measured at lower of cost and NRV. Now, that probably you may have inventory where you measured inventory at cost. Why? Because the NRV is higher than cost. NRV's net reserve value is higher than cost. So you may be technically correct saying that I have measured cost, but reason is that you measured cost because in your case, net reserve value is higher than cost. But if you mention in your accounting policy that raw material is work in progress is measured at cost or raw material is measured at cost, that gives incorrect indication to the stakeholders that you have ignored net realizable value. That means what the way you write down in accounting policy, it provides the information to your stakeholders that how the inventory is being valued. So this is incorrect. Lower of cost or NRV, and mind the friends that NRV is even applicable in case of raw material, work in progress, and finished goods. There is few misconception earlier that the NRV is only for finished goods. It's incorrect. Net realizable value, which has been defined under AS2, it says that estimated selling price less estimated cost of completion less estimated cost to sell. So if it's a raw material or it's work in progress, we need to assess what is estimated cost of completion, and if when the goods are ready, what will be my estimated selling price, and then I will arrive at NRV. So NRV is applicable for all class of inventories, not only to finished goods. So inventories shall be measured at lower of cost or NRV. That has to be clearly mentioned in the accounting policy. Otherwise, it's a big non-compliance as far as it is concerned. Coming to the next point, that is on the incorrect disclosure of cost formula. What is cost formula? Cost formula, sometimes we refer to a FIFO or a weighted average. See, when you just look at AS2, it provides that the company should mention or disclose the valuation of inventories, including cost formula. Now here it mentioned that The inventories are stated at lower cost and NRV, correct? Valuation is mentioned. Then it's mentioned cost is determined on weighted average or first in, first out basis as considered appropriate by the company. That is not a correct picture. We just think from the stakeholders' point of view. Somebody who is reading financial statements, it gives the indication that the company itself decides by themselves that whatever is appropriate. It is not the correct professional language to mention to accounting policy. Second way it mentioned, cost of inventories is computed on weighted average or FIFO basis. Again, it is incorrect. What has to be specific when you write down accounting policy? Probably it may be case where you are having a raw material cost formula weighted average. Work in progress can be a FIFO, but however, it has to be clear. Mind well, friends, that it says that inventories, valuation of inventory, and including cost formula to be disclosed. And inventory means classes of inventory has to be shown. So classes of inventory includes raw material, work in progress, finished goods, stock in trade. These all are classes of inventories. So whenever the valuation is mentioned, it has to be for each class. Same way, wherever cost formula is to mention, it has to be for each class. So this is the way your disclosure should be done. Accounting may be correct. However, what is written is more important because it suggests that the way accounting is done based on how and what is written in your financial statements. So not only doing is important, however, what is being reflected, what is being written is also or more important than what is being done. Let us look at now revenue recognition AS9. This also give me a little understanding, or I think reference to the recent controversies which happened for one of the very leading company. I'm not saying the name, however, we know that a company which is a leading educational tech company, and there has been an issue with respect to the revenue recognition. The investors has been very careful on accounting, plus the auditor of the company also talk about that revenue recognition is not done correctly. Revenue recognition is one of the very important point. Why? Because it affects your top line and also bottom line. If the revenue has been recognized on year end, which is not correctly being done, it directly impacts your top line, bottom line both. So the policy of recognition of revenue is again a very important thing. Let us look at the few companies, how they are disclosing or how they were disclosed earlier about the revenue recognition. It mentioned that the revenue from online educational services, if charged, is recognized upon receipt of subscription fee in case of non-refundable, otherwise apportioned over the subscription period. So basically, just look at this sentence. So basically, what it says that it is revenue is recognized upon receipt of subscription fees. Revenue has to be recognized on accrual basis. You cannot recognize revenue based on receipt. So it mentioned that in case of non-refundable. So non-refundable doesn't mean that you can recognize revenue on receipt basis. There are certain standard AS9 which provides you conditions, and that has to be fulfilled for the purpose of the revenue recognition. Second, it mentioned that in the annual report of another company, it says that revenue from online educational service is recognized upon receipt of subscription fees. I think these both are not correct, and that's why we need to be very clear that revenue shall be recognized on an accrual basis. It should be recognized over the period of service for which services are rendered. If I received all money in advance, however, I have not performed the services, it is not correct. It is kind of advance receipt of money. So revenue can be recognized only when the services are provided or goods have been delivered, or there are two conditions which need to be fulfilled. So AS9 prescribes this condition which has to be reported in your accounting policy. Come to the next point, which says that from the annual report of a company, it says the company is recognized as income the entire cost of garments destroyed by fire under other operating income based on filing of insurance claim. Plus, it mentioned that with regard to partially damaged stock, the related inventory has been valued at a net realizable value, and insurance claim against the same is taken as other income. Insurance claim against loss of fixed assets has also been recognized based on the claim filed with the insurance company. The note further said income has been recognized as per AS9. See, the first point is that AS9, it has been referred by the company in the accounting policy. AS9 talks about revenue recognition. However, insurance claim income is not a revenue. Revenue, which is defined under AS9, it is arising from operating activities. So, mentioning or labeling certain policies as a AS9 revenue is not correct. Second very important thing is that even though the AS9 does not talk about this policy, recognition of revenue or recognition of income, because income recognition is again should be based on certain principles. So recognition of income only on the basis of filing insurance claim. What it says that they have recognized income based on filing of insurance claim. Filing of insurance claim is not a substantiated because then it should be based on the collectibility. I may file insurance claim of 10 crore rupees. However, the amount may be receivable, maybe 8 crore rupees or 7 crore rupees. So revenue cannot be or income cannot be recognized only on the basis of filing of insurance claim. The accounting policies regarding recognition of dividend income has been disclosed as follows in the annual report of some of the companies. Dividend is accounted as and when received. Second, income and expenditure are recognized on accrual basis, except dividend on shares and units of mutual fund, which are recognized on cash basis. Again, I have mentioned earlier that there is no concept as far as this income is concerned to recognize on cash basis. Income shall be recognized on accrual basis, and AS9 specifies that the dividend income shall be recognized when the right to receive payment is established. So when the right to receive payment is established, then only dividend shall be recognized, and mentioning therein that it is recognized when the amount is received is incorrect accounting principles. Next point is that the following accounting policies on revenue recognition has been disclosed in annual report of the sum of companies. Revenue is recognized when no significant uncertainty as to measurability or collectibility exists. Revenue is accounted on accrual basis. Sales are accounted for on dispatch of products. AS9 primarily talks about two very, very important things. First is a timing, that is significant risk and reward is transferred. So when there is a significant risk and reward is transferred, that is one of the conditions for recognition revenue. A second thing, it also mentioned that there should not be any uncertainty of collection of revenue. So if there is uncertainty for collection of amount from the customer and significant risk and reward is or significant risk and reward is not transferred, then revenue cannot be recognized. The first case is mentioned that no significant uncertainty is there, but how there's no mention of risk and reward transfer. These both conditions are fully required. That's why the accounting policy should adequately talk about these both the points about the significant risk and reward transfer. And second very important thing is about the uncertainty on collection of these things. These both need to be mentioned appropriately in accounting policy. Coming to a very, very important point, that is employee benefits. I've been receiving a lot of queries as far as employee benefit account is concerned. And one of the most important query is on gratuity liability. Every company has employees, and when the employees are there, that means the gratuity may be required to be payable. So let us look at understand that what is the employee benefit requirement. Is there any exemptions or relaxations for a small medium company? Is there any relaxations for a non-company? We'll focus and discuss about both the things in this particular point. Various companies has non-compliances on the accounting of employee benefits. In accounting policy, sometimes it is not mentioned how the employee benefits are being recognized and measured. See, employee benefits categories include short-term employee benefit, post-employment benefit plans, other long-term employee benefits, and termination benefits. So these are the four categories of employee benefits. How the accounting is done, that should be disclosed as a part of accounting policy. Second, in notes on accounts, that also required to be disclosed about certain assumptions which are taken for the purpose of gratuity and other employee benefits. So in various companies, these kind of things are not been there. So please ensure that AS 15 has been compliant with it. Now coming to a very, very important point, which is a question for many of the chartered accountants in practice, that is about, do we have exemption from accounting of employee benefit? If it is a small company, if it is a medium-sized company, then do we have exemption? Yes, there are a few relaxations are provided, but practically there is no exemption from accounting or from accrual of the cost. Financial statements are true and fair. So financial statements can be true and fair only when we accrue the cost relevant to the income earned. There cannot be the exemption from accrual of the cost. So for small business companies, let us look at which are relaxation provided. First and foremost, compensated absence. So leaves is called compensated absences. It is short term accumulating. So accumulating is what? When the leave balance has been accumulated and can be carried forward to next year, it is called accumulating. Short term means it can be accumulated and carried forward for maximum 12 months. Vesting, non-vesting. Non-vesting means it cannot be encashed. So for example, if anybody leaves the company, it balance of leave, it expires, it is not being encashable. So there is exemption restriction from accounting of short-term accumulated compensated absences which are not vesting. If it's a defined contribution, so for post-employment benefit plans, there are mainly two parts. One is defined contribution and second is defined benefit. If it is defined contribution, means what? The amount to be payable is defined. So your liability is limited to the contribution which you have made. So it is called defined contribution. So for a defined contribution plan, your amount to be debited to profit loss account is equal to the contribution to be made. However, the standard says that if the contribution is to be made after more than 12 months, then the discounting may be required. If you are a small, medium-sized company, SMC is defined, then for you, no discount is required. Now coming to next very important part, which is a core important question for a lot of SMCs about creation of gratuity liability. Dear friends, gratuity is the obligation because it is covered under the Payment of Gratuity Act. If any staff provides services for more than 5 years, then the gratuity is required to be created. Sometimes a question which I have been encountered from a few members are that if the company has just started 2 years back, am I required to provide gratuity? The answer is yes. Why? Because even though gratuity may be payable after 5 years, but once the employee renders services, the obligation starts. If the employee leaves, you may not be required to paid. However, if the employee stays for more than 5 years, then at the end of 5th year, if any employee leaves on 6th year, then you are required to make payment even for the 1st year. So your liability to pay gratuity, it accumulates every day when the employee provides services. So even though the company is only for 2 years old, your liability of gratuity is being incurred every day as the service is provided. So gratuity liability is required to be provided. Let us look at what is the relaxations for SMC. If it is a small, medium-sized company, in that case, it says that you have to compulsorily provide gratuity or actual liability based on accrual, based on actual valuation. There is no exemption even from the actual valuation. However, it only provides you exemption from the detailed disclosure requirement. But still it says that you need to provide disclosure of actual assumption. So to sum it up, for a small companies, first and foremost, there is no exemption from providing liability of gratuity. You have to provide gratuity liability. Point number 2, gratuity liability has to be provided for SMC by actual valuation. Point number 3, actual valuation, if it is done, then you need to also provide the actual assumptions. So this is what is the SMC. For non-SMC, nothing to discuss, talk about the exemptions. Only for SMC, these few exemptions are provided. Now I just listed down about the for non-company entities. That means if your client or if you are a partnership firm, and for partnership firm it is not a company, then the Institute of Chartered Accountants of India has provided some exemptions based on level 1, 2, 3, 4, 5. For level 1, no exemption. For level 2, level 3, and level 4, exemption is being provided based on number of employees. So if it is more than 50 employees, practically no exemption. If it is less than 50 employees, then you can provide based on your Excel-based computation and not by way of the actual valuations. So that is what has been provided for non-companies. This is just to provide you a glance over the employee benefits. I know that there are a lot of companies where this may need to have compliance issues. Now coming to the next one point, there is related party transactions. Whatever frauds has been happened in last 10 years, starting from Satyam, out of 10, more than 8 cases, this has been by way of transfer of funds in related party concerns. So sister concern and the transaction with sister concern has been always an issue. It's a cause of concern for government. So government has tried to ensure that maximum disclosure has to be provided, and even investors look at that companies with the fishy mind, with the mind that the probability if the transaction or volume of transaction is very high with the related concerns, it really questions about the genuineness of the profitability, genuineness of the arms and transaction which has been there. So disclosure of related party transaction is very, very important. Please ensure the compliance thereof has been done. AS 18 provides a detailed understanding as far as the disclosure is concerned. And one very, very important thing which I would like to highlight here is that under AS 18, it says there are two main important points. First, it says that there are few disclosures which are compulsory. It has to be provided irrespective of the transaction. Means even if there is no transactions with the related party, the disclosure has to be provided. That is what it says, that you have to provide the name of related party and nature of relationship where the control exists. So if you are having control on anything like subsidiary company, so it has to be provided name and relationship has to be provided even though there is no transaction. For others, it says that you have to provide the disclosure only when if you're having transactions, and that disclosure includes the name of the related party, relationship, the nature of transactions, outstanding balance sheets, and if any amount is written off or written back. So these are the few items which require to be provided. Again, it says that you may aggregate similar nature of transactions, similar relationship transactions into one bucket, and then you can provide it. However, you need to ensure the compliance thereof. Now, come to the next point, that is on intangible assets. In certain financial statements, because there are a few old cases where the deferred revenue expenditure has been carried forward. Deferred revenue expenditure in practical sense means where the expenditure has been incurred, how it is over the period of the period. So the benefit is going to be received over the period, so the expenditure has been deferred over the number of years for which the benefit is going to be received. So deferred revenue expenditure sometimes has been mentioned separately. However, that is not correct. Now, there are a few companies which talks about that the expenditure incurred on factory license fees, trademark fees, seed marketing expenses, public capital issue expenses, preliminary expenses, and rental paid for pre-commencement of retail stores, factories has been treated as a deferred revenue expenditures. See, here we need to first understand the definition of intangible assets as per AS 26. AS 26 says identifiable non-monetary asset without physical substance. So if you have to apply certain amount of expenditure which has been incurred as an intangible assets, you have to ensure that the definition of AS 26 has been met. It says that identifiable non-monetary asset without physical substance. So first it should fulfill the definition of asset, then only it is intangible assets. So certain expenditure like basically the rental paid for pre-commencement of retail stores, factories, seed marketing expenses, public capital issue expenses, preliminary expenditure, these are not to be capitalized. These cannot be capitalized because this does not qualify to be the intangible assets. There is no concept of deferred revenue expenditure. AS 26 is to be applied, and the definition provided in the AS 26 is very clear. And for this expenditure, this is not being qualified to be intangible assets. With regard to factory license fees, trademark fees, this expenditure gives rise to intangible assets. However, it should be accounted as intangible assets. You can't label it as a deferred revenue expenditure. Deferred revenue expenditure itself provides a negative compliance. So if it is qualified to be intangible assets, then you present and label it as intangible assets. For a software development expenditure, product development expenditure under AS 26, it provides you certain criteria. So research and development, it provides a definition of research, development, when development starts. So all expenditure after development starts, which qualifies as a condition of our AS 26, then it can be capitalized as intangible assets. Next point is again on same thing, that says that basically the recognition of intangible assets is very important, and it says that put to use is not a correct word. The intangible assets shall be amortized from the date when it's available for use. Available for use is the word which is used for start of amortization. Put to use is not a correct word for the purpose of compliance of AS 26. Come to the next point, that is on AS 29, provisions, contingent liability, contingent assets. See, AS 29 it talks about the contingent liability. In one of the annual report, it mentions that the guarantees given by bankers for performance of contracts and others. We need to understand that the guarantee can be of two types. One is a financial guarantee and second is a performance guarantee. Performance guarantee is actually not guaranteed to be accounted. See, when companies sell the goods, the performance is being guaranteed. If the company sells the car should be able to run. It's called performance guarantee. So performance guarantee is not to be accounted. It's only a financial guarantee is to be accounted. Now, here in the annual report, it mentioned that a guarantee is given by bankers for performance of contracts and others. So, any guarantee which is given for own performance, it is not to be disclosed. That is called incorrect disclosure of this AS 29. Next is on provision for expenses. When you just look at annual report of the few companies, it mentioned long-term provision, short-term provision, and then under long-term, short-term provision, there is mentioned provision for expenses. See, generally, the expenses are being accrued. What is a provision? See, provision is basically the liability where there is substantial degree of estimation is required. So it's a liability of uncertain timing or amount is a provision. So only when there is uncertainty with respect to the timing or amount is involved, this substantial nature, then only you can label this provision. Generally, for expenses of normal nature, it may not be a provision. However, it may be other current liabilities. So that kind of segregation understanding is to be done when you classify or label something as a liability or provision. For provision, degree of uncertainty has to be at a higher level, then only you can label it as a provision, otherwise it is a liability. Next point is that basically the company has not provided for mopping of subsidy, has decided not to effect recovery till a policy in this regard is formulated. This strengthen the management's view for not providing the same. AS 29 makes it very clear that if you are not doing something, then you are required to quantify. We just look at these particular disclosures. It says that company has not provided. Why it is not provided? They mentioned it. But what is the significance of this amount? Is it affecting my true and fair? Where is the quantification is done? If the quantification is not practicable, it has to be mentioned in the accounting policy, in the notes on accounts, that it is impracticable to quantify it. However, if the amount is like more than double, triple, 10 times than the profit, and it is not provided for, it affects true and fairness. However, it is not a very, very important amount, fine, it is not so much important. So quantification of this particular thing is critical, which is not being done by this particular company in the annual report. Now we are coming to the next point, that is on non-compliance related to standards auditing. As we start a little late, please bear with me that I'm going to take a few 5-10 minutes more to ensure that we are able to cover up the few points which I feel are critical for all of us to understand. As I mentioned, that the quality is, how can you measure quality? The quality is measured by way of compliance of the requirement. So compliance of accounting standards, compliance of standard for auditing, compliance of laws and regulations, that means the financial reporting is of quality. So let us look at a few issues, a few important points which are relevant for all of us to understand from the auditor's point of view. Friends, here when you just look at the auditor's report, one of the very, very important point for the CA in practice or for the auditors is the audit report. In the whole annual report, there are a 2 pages document which is the most critical and important for the auditor is audit report. So we have to be very careful about every word, every sentence which is written in the auditor's report. SA 700 provides you format of auditor's report, and it says that there has to be a separate sanctions of management responsibility, auditor's responsibility, and opinion. So in few auditors report that was not available, it is not compliance with asset. Then in one of the companies, we observed that auditors report said auditors report only. There's no mention of independent auditors report. See, the word independent is a very, very important word. It signifies to the stakeholders that the auditor which has been provided report is independent, even though it is expected. However, mentioning that word is critical. So independent auditors report has to be mentioned appropriately. In certain auditors report, sometimes it has been observed that the cash flow statement is provided, however, reference is not there. And sometimes cash flow statement is not there, and there's a reference in audit report that true and fairness of cash flow statement. So we have been very, very critical and careful when this has been done. In certain case, we observed that under the report heading of report was report on other legal and regular requirements. The auditors reported AS 15 on employee benefits. The company has been providing for gratuity liability on an ad hoc basis, but not as stipulated by the standard. Refer note number 29.222. Now here, under the heading of report on other legal and regular requirement, this particular paragraph is written. Now, how can we know is it an emphasis matter? Because they are making reference to the note, it can be emphasis matter, but it is written under the other heading, or is it qualification? So this kind of obscure way of reporting should not be done. In one of the cases, it was mentioned that significant accounting policy and notes on accounts, which is a part of financial statements, were on the later head of the audit firm. Not allowed. Please refer to the auditor's report. It mentioned that preparation of financial statement is a responsible management. On the auditor's report or in auditor's letterhead, this cannot be there. In the annual report of a company, the note was given. The related parties and transaction with them, as specified in Accounting Standard 18, related party disclosures issued by ICI has been identified and given below on the basis of information available with the company, and the same has been relied upon by the auditor. See, relied upon by the auditor, if you write down in the notes on accounts, it reduces the significance of the whole audit process. It is providing disclaimer on something which is very critical for investors. Sometimes there is a fashion of writing that inventory is as certified by management. So you can't disclaim if the inventory is a very, very important figure on a financial statement. If you mentioned it is as certified by management, if the related party transaction is a very important transactions for a company, quantum is material, and when you mention relied by auditor, so this all signifies that the auditor has not done the job properly. It reduces the credibility of the audit and true and fairness of financial statements. So these kind of things are not. If you feel you have issues, you can issue qualified opinion, or like if based on materiality, the judgment can be taken. Now touching upon the non-compliance rate of Companies Act. Significant accounting policy to interest states that interest on earned on trade due is netted against interest expenses under finance cost. See, when we refer to Companies Act, Schedule 3 of Companies Act 2013, it provides you a format of financial statements. Under Schedule 3, there is a Division 1 accounting standards, Division 2 for non-Ind AS companies, and Division 3 is for NBFC. So the format of financial statements provided by companies following accounting standard is as per the Division 1 of Schedule 3 of Companies Act 2013. Under format, the finance cost has a specific classification. which says that interest expenditure and other borrowing costs separately. You cannot have a one-liner which says interest expenditure and finance cost. So interest expense and finance cost cannot be clubbed together, where the Schedule 3 requires you to provide the bifurcation or separation of the both the elements separately. Same way, bank and other financial charges, as I mentioned earlier. And for the first point, interest earned and interest expenditure is a point where you cannot net off income with expenditure. So grossing has to be provided. Interest expenditure, which is there under finance cost, and interest income should be part of other income. They both have to be disclosed separately. Both cannot be netted off. Long-term borrowings, terms of repayment of term loan and other loans to be disclosed. Now here it is mentioned, you to mention terms of repayment. Now repayment terms means what? Then the Schedule 3 Division 1 plus guidance notes mentioned that terms of repayment include period of maturity, number and amount of installment due, and other applicable rate of interest and other significant relevant terms, if any. So basically, these disclosures are crucial for the investors and financiers to understand the cash flow position of a company. That's why it has to be provided in this fashion. Under other current liabilities, others was mentioned. Other current liability, others was mentioned. But if you just look at Schedule 3, it says that if there's others, you have to specify nature of the item. Others simply is not sufficient. You need to look at the Schedule 3. It says that you specify the nature, and as per the nature of the item, you have to provide. Export benefits, profit on sale of assets were included as a part of revenue from operations. See, export benefits, it should be part of other operating income. Under revenue from operations, again, another part is other operating income. If it is export benefit, it should be part of other operating income. And profit on sale of asset is not from operations. The company doesn't have the operations of selling assets and buying assets. So it is not operations. It is other income. So that has to be part of other income. In one of the company, it was disclosed that capital advances disclosed as a short-term loans and advances. See, the capital advance, what is the nature and reason of capital advance? The capital advance has been given so that the fixed asset is to be capitalized. So the capital advance means advance given for the purpose of the capital asset or fixed assets or other things. That means it is not going to be converted into the short term. So capital advance, even Schedule 3, Division 1 said it should be part of long-term loans advances, not short-term loans advances. So with this, basically, I believe that we have tried to cover as much possible within a short period of time of 1 hour. The objective is just to provide you with the brief overview of the issues. But however, please know that basically these are the ICA publications which are available on ICA websites. Whatever I have given, that is only extract from the few observations from the ICI publication. However, if you have the appetite to learn, if you have the fire to know a lot of things, please refer to these publications. There are few publications on accounting standards. There are few on Ind AS. So there are 3 volumes on AS and there are 2 volumes on Ind AS that you can refer. And as I mentioned here, the most important thing is application. The objective of this particular webinar is to just touch upon the few very, very important points. But however, learning is not enough. Learning is half done if it is not applied to practice. So with this, I believe that please apply this learning in your case and ensure that we can increase the quality of financial reporting with this part. So before I end up, let me just look at any questions which you're having. I received a few questions. I'm just going through this question one by one. And then we can have understanding of one person from a science student. He says that can a revenue recognition be on completed contract method, or is it for a construction companies only? See, a revenue recognition AS9 is there, AS7 is for the construction contracts. So if you are talking about revenue from construction contract, you refer to AS7, and otherwise for services you can also refer to AS9, because AS9 also talks about revenue recognition for services. And under services, again, there are two options. There's completed contract method or percentage completion method. They both options are provided in accounting. You need to refer to the conditions provided under AS9 or AS7 as applicable in your cases. For construction contract revenue, refer to AS7. Can SMC accept valuation given by LIC for gratuity liability? I think that's a really very important point, that certain companies do it with LIC. See, LIC gratuity valuation is not a scientific way of doing valuation as per AS15. AS15 talks about projected unit credit method, PUC, projected unit credit method. If LIC is able to provide you actual report as per PUC method, you can follow that. Generally, what happens that the requirement of LIC is different and the requirement of account is different. Say both are on different footing. But however, if you receive a report based on PUC method, projected unit credit method, then yes, you can rely. Otherwise, you cannot rely only based on LIC actual valuation. If a company says it has not followed AS15 and gratuity is debited to P&L account when actually paid, can those financial statements said give true and fair view? See, true and fair view is more of like the qualitative nature of understanding taking decisions. It can be quantified. So you need to look at the materiality on the financial statements. If the company says it has been done based on the only amount is paid, look at the financial statements, understand the nature of business. If the company is in IT company where the number of employees is very high, and providing or not providing may have a material impact on financial statements, then it affects true and fair. Are we supposed to disclose the name of all intermediate holding companies? See, it says controlling, the name of controlling companies to be provided. So the control, if you are having control over that, it should be provided. So all intermediate holding company, as far as for your company is concerned, if you are in control over that companies, it is to be provided. For consolidated financial statements, can we rely on RPTs given by the auditors of foreign subsidiary, or are we supposed to check their RPT as per AS18? See, now it's a judgment where you take and you understand the financial statements prepared by a foreign subsidiary is under which GAAP. If it is based on IFRS or local GAAP, and then try to understand that AS18 compared to local GAAP. If the both are on same line, you may consider that. However, if you feel that they both are not on same line, then you cannot blindly take that particular part for consolidation. You may have to change. So little application of understanding of the gap under which the financial statements are prepared for foreign subsidiary is required. Gratuity provision is required only if payment of gratuity act is applicable. As provision is not required, Alpesh bhai, no, a gratuity provision is required because payment of gratuity act is applicable wherever the employee completes 5 years. So obviously payment of gratuity act is applicable only that is required. But however, there's no need to wait for 5 years. I think my point is that you don't need to wait for 5 years. If the gratuity is required to be payable, yes, then you have to make provision. If it is not applicable, if you are not required to make payment, then no, then there is no requirement to make any provision. How to show reversal of input tax, input GST credit on exempted goods in profit and loss account. See, basically look at, understand that any accounting is a very simple provision, very simple requirement of debit, credit, and income expenditure. So understand the framework which is provided by accounting standards. It defines what is asset, it defines what is liability, it defines what is income, what is expenditure. So reversal of IGST credit, ultimately, is it expense or not? If it is an expense, then it is to be debited to P&L account. So if it is not going to be available to you as an asset, that is expenditure. That's why you have to debit to P&L account. Is it compulsory to pay provision given by actuarial valuer for gratuity to LIC through gratuity fund, or we can have a non-funded portion? See, Ankit ji, basically what is very important, Ankit bhai, that LIC is an agency which takes the responsibility of administration of the gratuity. So what happens that LIC on periodic basis, based on information provided by the company, it calculates how much amount they will require. And based on that amount, we have to make payment. So payment to the LIC can be different, and the provision of liability can be different. So the funded, non-funded is what? Funded is when the liability has been backed by some fund, it is called funded. The liability is not backed by fund, it's called non-funded. But your provision or liability is definitely there. If it is not funded, it will be open-ended. However, liability or expenditure will be accrued based on the amount which is liable as per actual valuation. Okay, further clarification which you asked, I mean LIC demand 40 lakhs in quotation of gratuity, but actual valuer shows liability of 1 crore. What is the amount that needs to be contributed to LIC? So amount to be contributed to LIC is based on what LIC demands. Your liability is a 40 is how much? 1 crore. So liability is 1 crore. So your amount of liability has to be 1 crore as far as accounting is concerned. I hope, Ankit bhai, that is clear. Otherwise, you can also call me and ask question. If you still have any issue, I'm always available to you for any questions. Let me see, is there a question in chat box? PPT I will share. Yes, PPT I will share to Taxmann, and Taxmann will be able to share to all participants. Hetal has asked question, company having less than 10 employees need to provide for gratuity accounts. However, company has practice of paying gratuity on retirement of employees. Hetal, that is the actual real issues. The real issues which has been done is that right now, lot of companies are not providing. They just simply write down in the account saying that the gratuity is being done based on payment basis. Here in this case, we need to understand what is the materiality on the financial statements. What is the amount, how which, if you make provision, that what amount can come to P&L account, and if you don't make provision, how a financial statement can be impacted. So that analysis need to be done for you to understand whether you can do qualify or not. So qualification, emphasis matter, or adverse opinion should depend upon the amount by which your financial statements is materially misstated. So I hope that all questions have been taken care. And if you have any further questions, yes, I am available to you by way of, you can reach to me by my email ID or by my phone number, which has been available in my slide. And basically, the most important thing is that let us try to ensure that we comply with the requirement. The quality of financial reporting should and must go up with the joint efforts of all of us. With this, I'm again thanks to Taxmann for providing the opportunity, inviting me to share my views on the most contemporary topic for all of us. And thanks to each one of you for bearing with me as I joined a little late and ensuring that we got engaged through your question answers. Thank you once again.